Yesterday, State Street Global Markets bond strategist John Herrmann was on our broadcast with his preview of today's jobs report. Since the report came in better than he and many other economists expected, we wanted to see if it's had any impact on his outlook for the economy. So rejoining us, Bloomberg best economist John Herrmann. John, good to have you back. This report did surprise a lot of folks. I'm assuming it surprised you as well.
Yeah, I think there was a couple of things that looked a little bit not so clear. But I would say overall we'd have to say the takeaway was pretty positive. Let's just do a quick rundown. We had 154,000 gain in private payrolls. The June and the May estimate of private payrolls also upwardly revised, and they were up by 25,000. It's really critical to grow the private sector, as you know, because we still continue to cut the government sector. So it's very important to grow the private sector. And that we're doing. Okay, so that's the first good positive sign. There were a few little areas like the gain in retail and the gain in leisure hospitality looked a little bit suspect. We may not get that repeating next month, that kind of thing. But let's just overall let's just take it as it is and be happy with the result. We also got a decent gain in hourly wages. And the metric that I use for income, that metric rose 0.5% month on month in July. That's very decent. So that means the personal income report at the end of this month is going to be pretty decent.
So, John, John, let me just break in there because I'm curious, does any of this that we got today change your outlook for growth? I think you're forecasting close to 2% in the third and fourth quarters and 1% in the first quarter. Any of this do anything to change that forecast?
No, I think, basically we're still hovering right around, we think just a little bit above 2%. We're closer to maybe 2.3 after the report. So that doesn't really change that much. We're going to wait and see. We're going to need to see these job gains, whether or not they're sustainable going forward. And there's still some question marks. So, we're still concerned that the unemployment rate is going to rise over the next couple of months. So we're still worried about that. And that first quarter, I think that's why you're hearing President Obama go out on the tape all the time recently saying, hey, listen, we have to extend the payroll tax cut, extend the emergency unemployment claims, because I think he just doesn't, he's worried about the first quarter as well.
Right. Hey, listen, we talked with your buddy, David Rosenberg, earlier today. He says the U.S. economy is recession bound. Would you go that far?
I mean, that's a strong statement. Our probability would be closer to, let's say 30 to 40%, something in that range. We're really worried about the first quarter.
Right.
But
does it, hey, John, let me ask you, you track this. Does it even matter if it's 1% or less? I mean, it's going to feel like a recession.
It'll definitely feel like it, just like it felt in the first half of the year. In the first half of the year, we grew less than 1%, and it really felt pretty bad.
All right. What's our focal point for next week? Just quickly, John. It's the Fed meeting. What are you expecting?
I think we got to just, I think Chairman Bernanke is just going to be happy that we sort of dodged a bullet. I think he's going to be worried, though, about the fact that the stock market is down. So when they ended QE1, stock market fell about 16% cumulative. And since we ended QE2, stock market's down about 10%. So that becomes a hit, a drag on net worth. And as you know, net worth is tied to consumer spending, so that becomes a concern. So Chairman Bernanke will be watching things closely.
Yeah, it'll be a meeting that we'll be watching as well very closely. John Herrmann, thank you so much. John, you take care.
Thank you, Carol.